Rooney Vera. She's with Bull Tick Capital Markets and often joins us here to talk about the markets. Kathryn, thanks for being with us. Give us your sense on the state of affairs right now and where we go from here.
Well, the market has been conditioned over the past 10 years to really buy the dip, and without reason to do otherwise, at least in the very near term. That seems to be what is the case with markets pointing higher, as you said, John. And I think it's also important to note that with the ECB's announcement today that they will be making more purchases to keep rates lower, I think that really points to the higher likelihood of the Fed doing the same. There have been a lot of people saying that the Fed is unlikely to do much on the rates front, but I definitely disagree with that. And I think if rates move higher, which has been one of the main reasons for equities falling, U.S. Treasury yields moving dramatically higher over the past 2 months, up 60 basis points, with the velocity of the ascent of U.S. Treasury yields, my suspicion is that the Fed will follow in the footsteps of the ECB and do something similar. Maybe wait till yields move slightly higher. But certainly if yields in the 10-year Treasury space move towards that 1.75, 2% level, my suspicion is that the Fed starts to increase purchases rather than taper off purchases.
And given that, I wonder what it means for the markets in your view, because the storyline for the first couple of weeks, I want to say, of February and then into March was if bond yields are moving up, that is going to ultimately prompt some repositioning. And we've certainly seen some big profit taking in technology stocks based on some lofty valuations. If the Fed goes down that road, is that the kind of thing that you think is sort of a buy signal for some of those beaten up technology names?
Unequivocally, and I think that's why you see tech rallying today. I mean, the NASDAQ is leading U.S. equity futures higher. The dollar is weakening. This is a risk-on sentiment. And I think the rotation to value, the sector rotation that was so popular at the beginning of the year, perhaps was premature. So if, in fact, we do get a Fed that does not allow rates to move dramatically higher, which really does put in jeopardy everything that the Fed has tried for the past more than a decade to achieve, which is, of course, great liquidity, expansion of credit, ability to achieve that credit for various different classes of society, then I think that the rotation trade would have played out. But my suspicion is that in the absence of inflation, we're just going to have more of the same, which is more fiscal stimuli, right? More monetary stimuli. And if we have both of those two things, John, in the context of an economic recovery, then that's nothing but positive for equities. So, as I said, I think it's important to note that the market has been conditioned for buying on the dip, and it's a very potent force, this fiscal and monetary stimuli story. And combine that, John, with the subsiding pandemic, at least here in the United States, I think in Canada, in Europe, maybe not in Latin America, but certainly the situation is getting better. But especially here in the U.S. with the velocity of the vaccination, that is going to help foster a return to habits of consumption that we haven't yet seen. And my suspicion is that we're going to get an explosion in pent-up demand through the end of next year. And that's going to continue to keep pressure on yields. Now, I think the Fed is more apt to allow yields to move higher if it's a gradual movement, John. But if it's this, speedy, then it's a real shock to financing costs and puts in jeopardy not only 30-year fixed income mortgages, but business loans and consumer lending.
Yeah, a lot of people seem to be talking about that 2% threshold being something that would really more meaningfully impact some of the corporate borrowing. One thing I'm really curious about, Kathryn, since you're painting a picture where, generally speaking, the enthusiasm around stocks may continue, because we saw this rotation out of tech and into some of the more economically cyclical areas, and now the S&P for the year, I mean, the technology group is basically negative within that broader index, but energy has had this huge surge, give or take 40% for those stocks. Banks have had this big move. Can that momentum continue if you also see technology buying, if your thesis is that basically the way things are set up, it generally allows for more enthusiasm in the markets?
That's a great question. I think what it boils down to is the search for value. So tech catches a bid when it looks like it's valuable, and it's been severely beaten up, so it looks to present some value. The most beaten up sector coming into the year has for sure been oil, staples, utilities, even banks. So people are looking for value. I think tech also sold off because of questions with regard to valuation. So people are looking for value, and the fact is that whatever you may call it, the Federal Reserve's purchases of assets or fiscal stimuli, whatever it may be, equity markets have been dramatically bid up. So everyone's looking for value. So now tech presents value. The broader market presents value. But I do think that that the sectors that have really dragged the broader market are going to continue to play catch up. My S&P forecast remains 4,000 for the end of the year. I think in the absence of inflation, the Fed continues in the same trajectory. We already know we've had almost $1 trillion in stimulus and fiscal stimulus back in December, which hasn't even been fully executed. And this week we got another $1.9 trillion in additional stimulus on the fiscal side. And we're talking about another $4 trillion for the 10-year budget, thereabouts, going to be discussed here in the month of March. We're at almost a 20% fiscal deficit in the versus GDP here in the U.S., and the fiscal situation is certainly not retracing everything that in my view, everything that we've seen targeted or supposedly targeted toward COVID spending in the fiscal space is simply just going to become massive social spending. It's unlikely to be retraced. So I do think the outlook on the 12 to 24 month time frame is very clearly inflationary. But from now through year end, we still have a negative output cap. We're still crawling out of the hole from COVID. So I do think there's still space to run in equities.